Lovely people, an epilogue to the great recessional indicators, the depressional indicators, because that's what we're absolutely looking at. The thing that was irritating me is that one very key depression-based indicator measured against gold that was missing, that I forgot about, and that's one I regularly refer to, and just missed my list because I wanted this all-encompassing list to throw everything down for everybody to look at. And there's trades aplenty in all of them. Grand macro trades. This is the exciting thing. This is your moment to be the Big Short, the movie. In other words, this is going to be on large scale. However, do not over leverage. Do not get too aggressive. And remember, timing is everything. So you need to not be shaken out of the trade in an environment where many things could get very volatile. With that, I'm going to take you into copper, the one I meant to do that slipped through and is now part of this epilogue. This will be a short one. It's just going to be about epilogue copper, high grade copper. Okay, now silver's known sometimes as poor man's gold, and in some ways copper is almost a poor man's silver. So there is in China almost a degree of mini bullion status. They have used it as leverage and as an asset in some senses. There was Dr. Copper who was trying to corner the copper market. China does get a bit of copper. A lot of copper comes out of Peru, Chile, so the Latin countries. It's typically mined either directly for copper. Sometimes it's pulled up as a byproduct in gold mines. Along with silver as also a byproduct. Mainly silver is a byproduct in most instances. There are very few direct silver mines out there. Anyway, so here's the chart that you're looking at. Now the key aspect about this is, once again, the criminal crimes of Greenspan era. Greenspan is the greatest economic criminal, in my opinion, of introducing the extremity of high volatility and the pump and dump scheme where everybody gets sucked in, FOMOs into a major orchestrated pump and then gets shaken out and bankrupted on the down leg, and the Fed and the government and the Bolshevik agenda gets scooping up all the assets on the downdraft. And this volatility that actually the Federal Reserve and the central banking cartel has introduced is a standard tip-tap-toe to shake everybody in and get them all voluntarily chasing the game, give them leverage, and then pull the rug and grab all of everything at the bottom, and now leave everybody financially destitute and requiring government. Hence the future of potential UBI programs and bust pensions. Everybody is going to be reliant and without money, and who they're going to turn to. You're going to have a billionaire class, you're going to have a hollowed out middle class, and you're going to have this bloated working class of ex-middle class people, etc. And now do something, government do something, once again entrenching them and then leading to the socialist communist world order that they've been orchestrating. So here is copper. Let's go to the chart now after that little rant, that political rant of great fury. Let's go over here and have a look at copper. So since roughly the 87 crash, we've got a bit of copper, and you can see that largely it oscillated in a range like this against gold. My apologies, we're not there yet. I'm coming. This is copper's price. So it actually was not particularly interesting. This is copper's price over here. I'm getting my wires crossed. I'm going to be showing you against gold in a second. And you can see that that was the degree of stability. Now remember that Greenspan came in kind of around about 87 and he started having his effects. We had the dot-com bust, and then he went Mr. Big easy liquidity post the dot-com bust, and that saw a big surge in copper prices. And this was also led by the financialization of everything. And in the retail everyday guy that's not a financial broker or in the financial services sector, the way you leverage the retail guy in who's non-FS professional is property. Retail property. The biggest debts people own is homes, and you create a property boom, and that gets everybody chasing the game. Everyone becomes a speculator and a refurb hero, etc., etc. Now let's hold that point as we're getting to the 2000s, the low interest rates, getting the US, who actually dipped into recession in 2001. It led to Clinton beating Bush. during that era and getting in as president. And just do a segue. Where does copper get used? I'm talking about housing. So let's just confirm that one. And I'm going to expand that chart for you over here so that you can see that good and clear. This is where copper generally goes. Building and construction is the giant in the room. Right here, right there, the big one, and it's well more than a third. You can see it's 43%. You get a lot in electrical appliances, so that would be all your cheap consumer goods, your TVs, your hair dryers, etc. Then transport and equipment related to, so your trucks, lorries, so there's a bit of cars and potentially even trains, etc. Then consumer products, so we have a consumer boom where everybody buys and everything's disposable. You buy something, you use it for 3 years, you chuck it out. And then machinery, which will tend to be for businesses that make things. So plant. So that's going to be a bit more of a business. Most of this is B2C use. In other words, it's consumer driven because you will be the end purchaser of that home. Although obviously commercial offices, also it's building, it's construction and everything. Now, what does this blue area particularly require? If you think about this blue area, this is going to be financially leveraged. Building and construction, the way people make returns, they borrow from banks to build. Whether you're building a commercial office or retail homes as a developer, this has financial leveraging in it. Transport and equipment also has financial leverage in it. Machinery and plant for a medium-sized business that makes widgets and has a production line will also have bank borrowing in it. Consumer products can be cheap, you'll go buy it for cash, probably doesn't apply. Electrical and electronics, generally you'll buy it for cash, but some people might be using credit cards, but that's kind of minor league. But you can see the big slices here, the 19%, the 43% are going to be got financial leverage in them. So let's leave that copper chart usages and go back that pie diagram and go back to what we have here. So now we have the lowest interest rates environment in the world, and it is leading to the retail, particularly in America, but across the globe, property boom on low interest rates. So asset prices are supposedly going up. People are building new properties. We also had China's emergence coming, building cities, etc. A lot of that happening on. What did you get? You got a super spike out of a long-standing range that spanned since 89 right the way up to roughly 05 was when you started to break out of the range. So you're talking about, wow, quite a few years there, 16, 17 years, and I've got no more history to the left, but it was always around these levels and or lower. So here you have this mega demand for copper. People are building homes on a scale not seen before. China's building offices and homes. Everybody's going. So you get the super spike up to here. Now I would say within the new normal of Greenspan's pump the property, Fed prints for the world, low interest rate environment, and the rest of the central banking cartel, mind, we get a new range, but it's a very, very volatile range. So kind of on the resistance of the old range you have as kind of support that hit at the base bottom lows of 2008, 9. So after the 2008 bust here, there's your first major sell-off. However, and this goes back to the Shanghai Accord of 2016. China, that was relatively unindebted at that point, became the consumer of all commodities of last resort. So that's why Australia's property market flew straight through that. The money kept coming for commodities. Chinese money kept going, and they were the builders. In actual fact, copper had a snapback rally that took it to a higher in spite of the rest of the Western world's property market now being absolutely smashed out of the 2008, higher in 2011 than it was at the peak of the high. This is overdrive China. Then they started to stale out. We actually had an inverted HVF that we called there that said we'd get a much lower value for copper. We remember trading this. We've got all the charts for it. You got overperformance to the downside because it was the first in a new trend. I should clear this and lose a little bit of the old history now. Close, don't want lines. And just focus on this perverted copper market aka the central banking cartel that caused this commodity-based super spike. And this is bringing it up to slightly more recent history. As I say, we were involved in trading that, and it came all the way down here with overperformance to the downside. Then in the Trump, this was the Shanghai Accord area where China was totally bust now on debt after creating heat in the global economy and demand for commodities in the midst of a Western full-blown depression. So they went and maxed their credit card and kept heat in some degree of heat into the global economy during that period. And then we had the big G8 meeting when they were at the bottom of the barrel occurring in the 2016. That was when we forecast over there with a little squeeze on copper right there. It was a downside squeeze as well. We traded that one too. You can't see it. I'm still on the big time frames. I can't show you every trade we've ever had. And we don't only win, by the way. That was a downside that we took. But we did have an active period around here on copper. The last time that was of interest was here as we were selling off. That little setup hit out a low, and then we got the first upside setup here. This all dovetailed with the Shanghai Accord and Trump saying major infrastructure expenditure. Now, I don't know if any of that's truly materialized, but he talked up the game, and next thing you know, we got some spending again, and China, that was all beaten up. The West came and started doing some expenditure again on building, and we have largely, to a degree, in the US, reflated house prices to roughly what they were before in many areas, some even a little above. But next to gold, they are cheaper. That was what I couldn't show you on that Price-Schiller's formula that I was looking to do in the previous one. So this is the history now of copper. So now you got to ask yourself, how are we looking here? So let's get more current on the copper price and drop a time frame or two. It's important to understand your history in terms of what brings us into this state. And as I say, Greenspan, who's probably the most conspirator of note, people put it down to ignorance, and you know he said 2018 came out of the blue and he didn't know it. He knew what he was doing, in my view. Anyway, I do not think highly of him. So you have a kind of a head and shoulder structure here that's somewhat threatening. You've topped out there. This is a bigger right shoulder, but this is not a particularly strong looking chart. Now I'm going to take you to a different chart, which was the one I was threatening earlier. And that's the gold versus copper comparison. So why do we do this? Is he just throwing gold on everything that can be done? No. So copper, we've established, is being built on vehicles, and I am a big bear on retail cars particularly. So we've spoken of Tesla, we've spoken of Ford, we looked at Fiat Chrysler last time. Subprime cars in America, it's going to come home with a bang. I'm a bear on the financials. They're behind all the super lending to students and bad credit for cars and not caring about condition. So with the car market going to suffer from a glut of overproduction and a lack of demand is my premise. So if that's happening, you're going back to our pie diagram, transportation and equipment. One of the biggest slices here, the entire second biggest slice is going to drop. Consumer producers, if we have a downswing and there's less access to credit, less electrical and electronics will be bought. Consumer products, less of that will be bought. Building starts are going to fall through the wall. Building starts, by the way, if you're in the US, you get good stats for that. That's another indicator that you can watch along with lumber in America. But building and construction going down, this is a shrinking demand pot. Then you talk about medium-sized businesses buying machinery for making widgets. That's clearly going to go down with demand. People aren't going to be making investment at the same time as banks are being squeezed, a la the Barclays and the Deutsche Bank that I did in the previous videos. That were just two small samples of a number of things. By the way, latest news on Deutsche Bank, they're about to give birth to their toxic baby, a 50 billion bank, separate entity, just full of all the crap. Okay, so they're trying already to do the crash, the post-crash fix up of what is clearly a very, very sick bank. Okay, so let's transition. Having established that copper is actually an economic activity particularly in the areas I am most bearish. In other words, property is going to go down. They're all financially engineered. Cars and property are financially engineered with ridiculous leverage, 7-year loans with residuals on cars in the States to buy trucks for $85,000. Man, oh man, there's going to be a glut of second-hand cars running around real cheap. Then you have property that's going to have a downturn, and the banks that are going to have a downturn and cut lending. So the outlook for copper is seriously bad. At the same time, people are running in fear to buy their insurance policy on financial system failure, aka gold. So this indicator, gold divided by copper, is another very good relationship relative strength assessment. You're in a boom when gold is not being demanded, and you will be in a potential bust when you're at extremes of gold being demanded at the expense of copper. So what is the formula? It is gold divided by and I've gone for a continuous future to try get the maximum history. And once again, we've got a chart form from 89 for you here with this. So the good thing about getting the continuous future, I got a little bit more history. Listen, I would want back to the 60s. I love long-term history, but we've got to deal with what we've got available to us. Once again, so I've range traded this key period over here. So let's talk about the technicals right here, about the relationship here between copper and gold. Look at that relationship up to roughly 2003. This was quite an abrupt sell-off, but it was still within range. So I'll draw the line there. During that period, as I say, Greenspan came on at 87 around here. We started to have the relationship go down. In other words, what does that mean? Gold is relatively cheap and copper is getting relatively expensive. Then it swings up. It's doing pretty consistently inside the blue line range that I've done there. And this is a slight variance of economic cycle. Note at the lows here, gold was pretty cheap. At 2000 there was quite a boom, and then people got a bit cautious. So 2000 is around here. People got a bit cautious. Gold went up a little bit in price. There was less building going on. Then they did their rate cuts, and then you fell out of the range. And this is the key thing about when you fall out of ranges and the central banks get involved. You often have what I call the look one way extreme lows that leads to subsequent super spikes, and vice versa, where you get super spikes that then lead to super dip lows. In other words, the volatility is on both ends. We fell out of the range there on during that period. What was actually happening? Gold was beginning to creep up. You know, it's 99 was its $250 level. It was beginning to creep up, but nothing too dramatic at this point. But what did you have? You had this property subprime, pre-subprime boom that was literally being reinflated from the recession of 01 and 02. So during this period in economic history, you have a major property boom. What happens? Copper is being demanded. That's when we go back to the copper chart, I'll show it to you just quickly one more time. I'm in the other draw mode, so I'll lose all this drawing history. The copper broke out of its range. Do you remember out the top? I'll show you after we're done drawing here. So that led to this relationship dipping down. So even though gold was inching forward, we had copper absolutely mooning right the way out to the super high. And then China came back after 2008 and spiked it again. But during this period, it was all about the property. So this period was a huge property boom and consumer goods boom. So businesses were buying more machinery for their widgets. People were buying electronics like Load Tomorrow, flat screen TVs, all feeling good. We're making loads of money. Upgrading the car every 18 months to 2.5 years. Why? Because your house has gone up $100,000. Extend the mortgage, buy a new car, live the life of Riley, impress your friends. Okay, so that was the fake boom pump that got everyone in. Then we hit 2008. Fascinating. This is where we suddenly start to have our Lehman's moment. What happens? The demand for copper absolutely plummets, and everyone starts asking, Jesus, we should be getting our insurance. Super spike in the relationship of gold up into 2009. Then we got China starting to be the engine for growth in an absolutely flattened Western environment. So what happened? They started buying copper and actually pushed it to a new high. We came back into the original range and met all the way to the low. But gold was still climbing, ended up hitting its high around about 11. and during that period, and we're now popping out consistently out the top of the range here. So the gold relative high, and then copper traded down, down, down. And even though gold is not near its $1,927 high of 2011, the relationship with copper is stronger, much stronger. And in actual fact, when I wipe my face and clear this up a bit because it's getting messy, let's lose that history that's all in the range and just deal with the perversion of the subprime boom that was brought to us by all our central banking cabalists that are intent on creating pump and dump schemes, and thereby shake out the retail investor out of his homes and turn him into tenants in his own home. Yep. So what do we actually have here? We actually have a massive continuation pattern in this relationship like this. And what you're actually finding is, even though you had, a bit of the China buying, it never got down to the lower end of this range. And in fact, that was the midpoint of the original range, and we've turned around and we've started working our way up again. So what you have, this is a classic case of a macro, super macro pattern, which is pointing to a super spike in protection, insurance against financial system failure that will go off the chart, in my view, quite potentially, for gold, and a complete downdraft of inactivity on new build property development, consuming vehicular making a massive fall off in demand and a slump in the copper prices. Now, if we get those two things simultaneously, a slump in demand in all those sectors that we've highlighted already here for you, and we get the real people starting to wake up. Most people have no gold in their portfolio, people. Gold was deportfolioized from the 80s. Only losers and retro people from 1982 still spoke about gold. It's been the likes of Buffett and everybody have poo-pooed it, and everybody has been rah-rah, the financialization of everything, margin for buying your stocks, everything. The great financialization truly unwinds. You get the super spike on this pair like no tomorrow. Very little invested in new plant, very little going into new buildings, many people being turned out of existing buildings that can be repurposed. China has built for the next 20 years that they don't need to turn soil for a long time. Massive fall off in consumer demands and products, oversupply of cars, people keeping their cars for 10, 15 years again, like they used to pre the financialization of everything era and the cheap money. And the cheap money detox is yet to happen. These are tremors, these swings are tremors in what can be a super quake that will dwarf these. And this is a very useful indicator, and this is just the stirring. The recent moving is a minor stirring in gold, which I think we will see it make another high and then potentially move to greater heights. And this is also going to be negative on general building activity particular, but those other industries. So that is your gold to copper ratio that I wanted to introduce as well, which is another point, another technical display of real potential for runaway power to gold at the expense of economic activity. In other words, more people are waking up to financial insurance against a failing reset sniper environment. Okay, the market sniper is your technical method. The crypto sniper, as I've already shown, is going to be one of the most powerful areas for getting your winning. Get into Bitcoin. Bitcoin dominance is back, and of course the reset is coming, and these patterns are setting up. It doesn't look like it has to run today. This is a monthly chart, so you don't have to drop your tools right this second, but you certainly want to be thinking how you are prepared. With that, this is the epilogue. I can't think of too many more indicators that I can get true charts for. There are other things that you can't easily get charts. Watch the house pricing. Watch the house pricing starts in the States where you get that. Watch the 20 cities index, price it against gold, you'll see that it's actually not gone up in gold ounces. Actually, in the UK, where I downloaded the big Excel sheets with nationwide Halifax housing prices, at one point prior the financialization of everything era, you weren't much over a single gold ounce for an everyday average British home. Will we return to that extremity? All that's happened is we've had bigger pumps in the number of ounces to buy a home, with bigger dumps, and the volatility keeps increasing. Your central banking cartel have not provided security and stability. They are the active causes of increased volatility through asset price manipulation and cheap credit in a debt-based society that has lost its mind. Recognize who your enemies are, take appropriate action. Okay, with that message, I leave you and say goodbye, enjoy this epilogue, and we'll talk again soon. All the best. By the way, go to themarketsniper.com if you want to find out how we're doing, what we're doing, and you want to learn more about HVF method. And there's also a mini series in the notes below. Grab that. Costs you nothing. Go and watch, and you'll get a little bit more about what we're about. Thanks for watching. Please share and rate. It helps what we do. There's no monetization on this channel to keep it ad-free for you. And if you enjoy it and you value it, sharing and rating is greatly appreciated. Thank you.